He's angry about mortgages. It's Angry Mortgage. He's swearing. He's cursing loud. He's old. He's opinionated. And he's been doing this so damn long. This program is about mortgages, and this is mortgage advice, but the advice may not apply to your situation. Contact licensed mortgage professionals for specific recommendations before you make decisions about mortgages. You may not agree with Ron, but if you don't, he thinks you're wrong. Oh, and did we say there is a lot of swearing?
And we are back with Sebastian Kuperhause. You are now the Vice President of Sales Ontario at Sequence Capital.
That is correct.
So I always have trouble with these names. So apparently we want to use a new name for big private lending companies. We want to call them mortgage investment entities.
Mm-hmm.
Why do we change the name? It was a MIC forever, right? We called it a mortgage investment corp. Now it's a mortgage investment entity.
Yeah, the oversimplification of it, I think it's to clarify what we are in the space.
Okay. All right.
I know it's a pretty straightforward answer, but yeah.
I'm going to keep calling you Mix. I'm going to call everybody like this a Mick.
Yep.
And then eventually it'll get pounded into me. I got to call it MIE. Okay.
But think about alt lending, private. What was it? You had B lending, alt lending. Everything changes. Everything has a name and it changes.
Everybody wants to change names of everything. Okay. Like
you're trying to clarify. They
changed. Like we used to always call taxes, but now the government calls it an investment. Okay, so yes. Investment sounds better than just fucking taxes, right? So there we go.
It makes you feel bebetter.
Yeah, because that's what government says all the time. We're investing in this program. Don't you have to raise my taxes? No, maybe. So that's where we're at.
Little that.
All right, let's break it all down.
Sure.
Because we've got not everybody who listens to the pod's a mortgage guy or a mortgage gal. And so let's break it all down. So in the world of lending for mortgages, it's easy to say we have, sort of three tiers. So we got your banks, your credit unions, your trust companies. Mm-hmm. We'll just call them AAA, federally regulated, and sometimes provincially regulated, but they're all regulated. And they're, they are the top of the food chain. They are the best rates. They are the most. They have certain restrictions. Mm-hmm. That's fair to say, right? Banks, credit unions, top of the food chain, but they got best rate. But not everybody can get in. You got to be a relatively good person to get in. And you used to work for a bank at one time.
I did. I actually started my career in the banks.
Yeah. So that box, even though there's a ton of people fit in the box,
yes,
it's still a box.
Okay, I refer to it as paint by numbers.
Yep, it's you gotta just fit in. Okay.
Yes.
Then we've got alternative lenders. By the way, folks, Sebastian just referred to it. We used to call them all B lenders. Okay, but then everybody thought that we had all the people who had these B mortgages. They thought to themselves, "Fuck this! I want to be A. Don't call me B." So when we call them alternative, I guess it made them feel better. That's all I can figure out. Okay.
Sure.
So alternative lenders. These are like regulators that are still regulated. They're still regulated by federal government or provincial government situation. They've got P's and Q's they've got in mind, but they got a wider box. They got a wider box to fit people into.
Correct.
So those people can have credit impairments. Like at a bank, you can't have bad credit. You can't have a lousy credit score. It's impossible. Okay. But these other lenders, you can. And, there's a number of them. And then finally, we have mortgage investment entities or mortgage investment companies. We'll call them mixed. We'll call it what often the public refers to as private lending.
Yes.
That's fair. And is it fair to say that private lending is everything else?
Yes.
Okay.
It is fair.
Yeah. All right. So that's everything else. All right. So let's just talk for a second about where people fit. So we talked about the banks and the credit unions, trust companies. that's a decent. It's a credit score that has a minimum, right? Like there's no bad FICO scores in there. They are really ugly FICO scores, and their incomes have to be understandable. Okay, provable. So by understandable, it means okay. Here's a pay stub and a job letter. Here's a tax document that proves, and here's my corporation documents. I'm a business.
T4s, NOAs.
And these have to hit certain key standards. We typically refer to them as debt ratios. But for the public, it's just to say you have to have enough income versus debt in your life. Okay, there's ratios you have to hit. There's percentages you have to hit. And most people hit them. Like I'd say a lot of people who have buying houses or own houses usually hit them.
Even in this market, absolutely. Yeah. Lots of them.
Yeah. So alternative, and you work for alternative lenders.
I have.
And so you think about Sebastian. He's an expert on all of this stuff. He can see the whole spectrum of how lending works. Okay?
I appreciate that. I've been doing this just a couple of years. I tried to joke one time. I was like, I started when I had hair. Like, no, wait a second. I didn't have hair back then. Still don't have hair today. I have more hair on my face than I ever had on my head, but it's good. That's how long I've been doing this for.
All right. So, but long. It's been long.
Long enough.
I've known Sebastian a long time.
We have.
So the alternative lenders, we're still against the law to name them. Okay. So we can say it's like Home Trust, Equitable Bank, Community Trust, Haven Tree. Haven Tree is a trust, right? Is Haven Tree a trust? Yeah. Okay. And there's a few others. Okay.
It's Haven Tree Bank.
Haven Tree Bank. Sorry. And there's some credit unions that actually specialize in it.
Correct.
Right.
Yeah. And they're all great organizations. They're all well run.
They're all well run. They're all and before people start to think that how can they do it and not why can't the banks do it or what's going on? Well, I think that explanation is fairly simple. The Government of Canada and its regulator, OSFI, which is the Office of the Superintendent of Financial Institutions, they got to accept that, look, if you have the right capital structure and you have the right approach to equity in the property, we shouldn't deny Canadians who don't fit right into the banks, we shouldn't deny them the opportunity to get a mortgage.
Correct.
They're probably going to have to pay more. Definitely going to have to pay more. They're not going to be able to get there's no 5% down for them at all, okay? But why not? Why not give that safety valve to Canadians who get a little bit of trouble in their lives, something going wrong? You know, the old saying.
Life events happen often.
They happen, and bad things happen to good people.
100%.
It's my friend Nick Cipriano's favorite.
Yeah, actually, I've heard Nick say that. I've heard Nick say that before.
Bad things happen to good people.
Yes.
Yes, and that makes sense. That's a marriage breakdown. That's illness. That's like lots of things can go wrong. And the alternative lenders have a spot there for people who have problems with FICO scores, problems with credit scores, and problems, a limited level of problems proving their income.
Well, but even sometimes it's not even that. It's extended ratios. So the fact of the matter is everything fits the box, but it's just the ratios are just a little too high
for a bank.
For a bank. And then the alternative space will happily take on that client and work with them to get them to a place where hopefully a year, 2 years, or 3 years later, everything kind of corrects itself, and then they're back into the space. And the same principle applies in the mixed space, in the MIE place.
Yeah. Now, the real benefit of these alternative lenders is that they are operating off deposits. They have a balance sheet. They have an underwriting approach that's very rational. Okay, I mean, and they follow rules. And the great thing about them, though, is if they say yes and you got that mortgage, it's the same sort of relationship you have with a bank. Your interest rate's not so hot. You paid some fees off the hop, some extra fees you don't pay at a bank, but they will renew you. I mean, they will, unless you have a horrible payment history, they will renew you. And they will, and if you miss a couple of payments, they'll work with you a bit. Banks are a little bit more generous on the missing a couple of payments scenario, but everybody has to deal. You can't go past 90 days, folks. That's the way it works at every financial institution. 90 days is a big issue. If you're still late after 90 days, it's a problem. But they can work with people. And if I would say, would it be fair to say, Sebastian, the greatest benefit is that those alternative lenders, unless something has gone spectacularly wrong with payments or wildly wrong with property, like something's gone really, really wrong with the property or the region, you'll keep getting renewed.
Yes.
Yeah, you'll keep getting renewed.
Yeah, listen, I think at the end of it, because everybody looks at the business model, and if the clients are a good payer and the market volatility, you're not concerned about the loan to value, you're not concerned about the marketability. If something was to happen, then there shouldn't be an issue in renewing a client.
And typically there isn't.
Correct.
So, and typically any charges at renewal from these alternative lenders who are governed through the Department of Finance, there's not a big fee. It's a small fee. Okay, small fee to renew, and or sometimes no fee if they're perfect payers. I mean,
yeah, potentially
there could be perfectly fair renewal offered. By the way, it's never the same as a bank. I keep emphasizing that. And there's nobody at Home Trust who would disagree with me, or EQ Bank, or Community Trust who disagree with me. The rate's never the same as a bank, okay? Although sometimes it's not ridiculously off, okay? Sometimes it's only 1% more.
Yeah, and the difference is that it's not a 5-year term, it's a 1-year term. But actually what you're seeing a lot more is the 2 and the 3-year term, because the market, you're also recognizing the market, and the client are good. They're good consumers and they pay. So why wouldn't you necessarily look at longer term and really help support? Because if you look at historically, when you look at a book of business, a client would come in and we would know that they're going to be on the books longer than 12 months, right? So, and over the years, what you've seen is the proliferation of people going longer and longer in terms of terms in the alternative space, because what's happened is you think about job and values or employment or life events or whatnot, but they're also looking at, also when you look at post-COVID, rates went through the roof.
Yep.
And everybody looks like, I need to protect myself more long-term. So they're taking 2 and 3-year terms, because the reality too is, when we talk about in the private space, is that what is your exit strategy, and is it really plausible? That's the really biggest question. Is, you see the thing, you see the answer is like, the client's gonna be able to do this, and 12 months from now we're going to refinance, we're going to take them back to an A bank. Sure, but when you look at it, it's like, is that really what can happen to the consumer? Is that really possible? Or is it really, are you better served they need a 2-year term? Because really it's going to be 12 months, probably more like 18, maybe 20. And you're better off to hedge and protect the client for a longer period of time, because that's really what is in the best interest of the client. And that is part of, when you're a broker, you're going to sit there and you're going to explain it to them why you should go longer versus taking 1 year. Take your bet on a year from now, I can try to renew you, I can try to refinance you, try to move you. But you're also seeing consumers where they're like, I'd rather just play safe. And it's definitely the right choice for a lot of people. Then from some other people, it's not necessarily the right choice for them.
Yeah, it's a very, very great point, and we're going to come back to it a few times. This is about, if people are engaged with any kind of alternative lender, whether it's the institutional alternative lender or whether it's the most nitty-gritty mom-and-pop private lender, the question of how long the borrower will need to be in that space is important. It's very important. So here's the first thing. If you're talking, and this is just for people who have ever gotten in that situation, you can't fix your credit in months. Unless that's 10%. Out of 100%, that's 10%. Can absolutely, yes, no problem. There's only one issue here. We'll pay it off, and everything will be changed completely in a few months.
Or my favorite line, you can always get dumb lucky and win the lottery.
Yes, if you win the lottery, you may not even need the mortgage. Yeah,
exactly.
That's it. But for the majority of people, if a mortgage professional ever tells you, if a mortgage broker just tells you, look, yeah, your credit will be fine in a year, That's unique. That's like a 10% scenario, 15% of all those loans. Your credit will not be perfect in 12 months because if you've had real ugly delinquency on a credit card or a personal line of credit, or particularly when it's on a mortgage, you've had delinquency.
Yes.
You ain't fixed in 12 months at all. So to Sebastian's point, some people are being misled about how long they need to be in an alternative space. I mean, if your credit is buggered, you are probably a 2 to 3 year way to get, it's going to take you to get there. Also, if you're in a private mortgage or in an alternative mortgage because of your income not quite working, then two things have got to happen. You've either got to radically increase the amount of taxable income you're paying, or you've got to get a better job. And sometimes either one of those things is just not like falling off a log. Okay.
But the reality too is sometimes they're just better suited to be in that world forever.
Yes,
and
that's a good point.
There is a subset of clients that how they build their business, how they generate their income, they are better suited to stay in the alternative space, the private space, because the alternative is the sheer amount of tax they have to pay. They wouldn't be able to live the lifestyle that they live and be in the home that they have and so on and so forth.
Yes, this is an important point to consider. So a lot of people in the alternative space who are not eligible to go to a bank are there because they don't show much income. Now, I won't use all the euphemisms. Like a lot of times people want to, you don't have to say a thing, Sebastian. You're not required to say anything on this. But a lot of times you're going to hear the expression, yes, tax planning, or because accountants are able to apply certain criteria. You're going to hear a lot of bullshit, okay, about, let me tell you what it's really like. It's really about people are not reporting their income fully, okay? That's what it is. It's about businesses that have a cash component. Believe it or not, that still exists. There is still cash running around. You will ask every fucking tradesperson who wants to do renovation on your home whether there's a discount for cash, okay? Believe it or not, folks, they don't report that cash, okay? So they are making a bunch of money not paying tax. And there's a big advantage. As soon as you're making like a 200 grand gross income and you can hide half of it, that's a lot of tax savings. Right. Wow. Okay. Huge.
But you also
don't say anything. You can stay away from this one, Sebastian. Okay. You stay away. Okay. So then what I'm suggesting to you, not Sebastian, what I'm suggesting to you is that some people would rather just try to keep avoiding CRA, keep actually stating their true income. They'd rather avoid that forever because that saves them 50, 60, 70 grand a year, and they're okay paying 20 grand extra on their mortgage. That's what it's about, okay? Now, that's not a huge subset. That's not a big subset of people, but it exists, okay?
No doubt over the years, you've been doing this for a long time as well. How many times have you sat and you talked to somebody and you're showing us like, here's the advantage of one way or the other. But again, it's up to you to make the decision in your tax and your life. And you're going to talk to your tax accountant and everything and make sure what is the best way for you to be able to report.
And the other consideration is that sometimes everybody decides to come clean because CRA can look into you. Remember, they can 100%. Look the fuck into you. They can take a colonoscopy probe to you, okay? I remember best one I ever heard of a buddy of mine was in the built fences, and built decks and fences, okay? They built decks and fences, so those were a lot of cash jobs, like tons and tons of cash jobs. And one day, somebody phones him up and says, "Could I get an estimate on this?" And he gives the whole story, what his deck looks like, everything else. And and then they gave him an estimate. Of course, then immediately, buddy says, "Yeah, and it's 15% off for cash." Oh, sorry, 15% off for cash? Like if I actually handed you folding money, like actual cash, that I would get 15% off? He says, "Yes, that's right." And the person on the other line says, "Thank you very much. I told you that my name was Roland. Okay. I'm Roland with the CRA. So we're going to be sending you a letter next week.
Enjoy that one.
Because they do it by waves, right? Like they say, let's go through everybody who's building decks and fences in Southern Ontario. We're going to do we're going to call everybody. We're going to call everyone. Okay. Same thing for a bunch of other stuff. I mean, but yeah, I mean, you get caught. And it's funny, once you're caught and you know you're going to be audited every year for the next 10 years, you just say, fuck it, I'm going to show the income. So then eventually you may be getting back to dealing with a bank. It can happen. So because I think it's fair to say there's very few times that alternative lending runs for more than 3 or 4 years. It usually resolves itself eventually, one way or the other. Like, sometimes people make so much money they just say to hell with it. I'm doing so well in the DAC business and I haven't been caught yet, so I'm just going to start to show more income. Then I don't need it. I don't need all this anymore. All right. But it's, again, real important. Anybody who says they've got a strategy any mortgage broker says, I can show you a way to fix your credit in a year, and you're a 510 Beacon score, 510 FICO score, do not believe that person. Okay. Like if you've got like M3, which is like you've got 3 months arrears on mortgages off and on, do not believe that person. Like you actually need a longer term. All right. So let's talk now about why somebody would not fit into any of the boxes except private lending, except MIEs, mix, all the kind of, and even mom and pa.
Privates, yep.
Because this is really interesting. There's a lot of human beings, particularly in places like Toronto, Montreal, to a certain extent Vancouver. But in Toronto, Montreal, there's a lot of human beings who do private lending. Just human beings. Okay, yes. They're not a company. Sometimes they operate a tiny company of their own. Okay, yep. And there's also lawyers. There's lawyers who specialize in private lending. Even though in theory they cannot advertise, in theory, okay, because that is against there's one rule. They don't have to be licensed as mortgage broker. No mortgage broker who arranges a private mortgage, no lawyer who arranges a private mortgage needs to be licensed as a mortgage broker unless they advertise. So none of them advertise, but they find ways of getting their name out there, okay? There's not many of them. They're a small group, okay? Sebastian and I know who they are, okay? And they have very few constraints. Lawyers have very few constraints on private lending. That's fair to say, right? I mean, they don't have any. There's effectively no regulator. There's a law society that may audit them, but the law society is not studying how these lawyers are doing the loans. They're just making sure they're handling the money correctly. That's how it works. No. So once you're outside of the banks and outside of the alternative regulated lenders, we're in a different world. So now let's talk about that for a minute.
Sure.
Now, the organization you represent, Sequence, is big. Like it's big, okay?
We're big. We're big enough.
You're big. No, you're not. You're just big, okay? Now, I'll tell you something about, I had the pleasure of meeting with some of the bosses at Sebastian's company, and it's big, and it's well-run, and it's...
been doing this a long time.
Long time. Like, so, but by the way, that's really important to the private lending business.
Yes.
Is how have they been doing this forever? Because if they've been doing it forever, for decades, then you say to yourself, well, wait a second. I mean, they're not going anywhere. They're fine. They're established. They're going to be good. Okay. And that's like, you don't have to ask that of a bank. Bank's going to be probably fine. Okay. Credit union's probably fine. Yep. Okay. But when it comes to...
And as the government looks at them, too big to fail.
All that stuff. Yeah. So bottom line is this. When you're talking to a company that's not in that regulated space, one of the mix, one of the MIEs, mom and pa's in a different category, but you're talking about these companies. Big and old is important. That's my opinion. And you guys are both big and old. Okay.
We are.
And why is that important to the borrower? Why would you say it's important, Sebastian?
Well, I think there's a few things, and I'll actually compare it to a bank. Why does somebody walk into a big bank? It's because they've been around for a long time. You know that they've been there. They've been through the highs and the lows. They know how to manage. And the expectation is they're going to be there 10, 20, 30 years later.
100%.
Right. So the same principle applies. If you look at this space, there's been a proliferation of privates, and there are some amazingly run companies out there, and they've been doing this for a long time. I think what you've seen in probably the last 10 years is that where companies may have been, just a few, 100 million, now because of the market and how it's shifted, we've all become a much, much bigger. I mean, I know you made the comment when you were talking with, I think it was with David, but it was where, you have two privates in our space, there was a merger and they just became bigger. And I think when you see things like that, it really helps to demonstrate that there is when you're looking at the MIE space and the private spaces, you really need to understand where they are, where they've been, and where the expectation they're going to be down the road. Because at the end of it, it really becomes like I said about the bank, is the expectation that they're going to be there. And when you look at our organization, we've been doing this for a very, very, very long time.
It's decades.
Yeah. Right? And it's an incredible story. Because when I joined the organization, I got to understand and got to meet everybody, and we're not a small shop.
No.
We're over 100 employees. We have offices, we started off in BC, we have offices, but we've really grown, but it's really over the years. But it's, again, I've said in the last decade is probably when you see the most amount of growth in the space. Part of it is regulatory because a lot of things have shifted our way.
So, again, for the people listening out there who might someday be confronted with the need for private lending or out-of-bank lending, and just for all the other people who are in the business of finance, this thing about a big, old organization, it's meaningful, and we'll get to the kind of ugly reasons why it's meaningful in a minute, but that's an important part of trying to understand who you should be dealing with.
Yeah.
And the other consideration is that all of this stuff is marketed apart from the lawyers who are, have different ways of attracting business to private lending. All of the stuff is regulated as hell. Like, you've got to be licensed as a mortgage broker or mortgage agent in order to introduce anyone to private lending and assist in that getting that file done.
Yes.
Okay. Like, you just can't say, hey, I'm Joe Blow and I think I got a deal through Sequence Capital, so I'm going to phone up Sequence Capital and help my cousin get one. No, you cannot do that. Okay. I don't think Sequence Capital even takes that call, right? I mean,
because we have to have a brokerage, but realistically, we fund through mortgage brokers.
Yeah. So that's important to understand. It's a mortgage brokerage. Therefore, mortgage broker, mortgage agents are the sole distributors of almost all of this and all this kind of lending. And they're 100% commission. That's reality.
Yeah, mortgage brokers,
100% commission business. Okay?
100%.
Now, what that can lead to is all kinds of results, ranging from excellent results to fucking piss poor results. Okay, so let's start to break it down. So people, and let's face it too, sometimes there's very short-term situations. There is such a thing as a bridge a bank won't do. Like, you've sold a house, but you haven't sold your other house. And the bank's position is, look, we'll do bridges, we'll help you with that, but you have to have both houses sold. Okay, we're not. There's no such thing as a bridge forever, so that we don't know it's ever going to sell. So we can't help you there. But private lending can help you. And often does. So that's damn short term. Okay.
Yeah. And the idea behind those is because they're in for whatever, 60, 90, 120 days.
Yeah.
And then we look at that, and because we know they've bought the other property, you potentially look at blanketing so that you protect yourself. But yes.
Sure, but so that it's providing a service for something, and this doesn't happen every day, although it's happening a little bit more lately, okay, because people don't understand that it's harder to sell their house now. They should. Their realtor should have advised them. Everybody, let's just make it really clear. Everybody, I'll say this for the 100th time. You got to sell your house first before you buy the next one in Ontario, okay? That's it.
And the irony to that comment is, even when the market, and my wife and I, through COVID, we're like, do we buy another house? Do we look at doing? And I'm like, well, we can get X for our house, which is fantastic, right? Like the market's smoking hot.
Oh, 21, smoking hot. Mortgage it was the biggest, best year in the history of history.
But then you're also buying at a high.
For sure.
And I remember because there was, we were talking to realtors and like, okay, so you're going to put an offer on this house? And I said, why would I do that? I haven't sold mine yet. They're like, but it'll sell. I'm like, no, listen, I come from this space. I understand. I'm probably the anomaly but now and today I'm part of the mainstream. But back in the day, I was the anomaly. I would never have bought a house if I owned a house without selling it first, because I needed to know how much money I really have to go
Precisely,
buy.
Yeah.
But the market shifted in a way that was so fast. But it was interesting because if you look at the market in Quebec versus the market in Ontario, they react in very different ways.
Very different. Totally different.
Very different.
Yeah.
And I mean, grew up in Quebec. I'm from Quebec. So that mindset stuck to me even here, because I've always looked at a transaction. Why would I go buy the biggest purchase of my life with another really big debt hanging on me without dealing with that first?
Yeah, but you're right. In 2021, everybody was universally told, no, you do not sell this house. We're going to buy a new one first. Okay, because these things are selling so fast. You got to grab one, or you'll never know. You can't sell and have no place to live. You got to. Okay, we know the spiel that was given. Yeah. So, but today it's not. It's the reverse. You must. If your real estate agent tells you, no, don't worry, we'll just buy this new house now and you won't have any trouble selling, your most important phrase you can immediately react to that is, you should fuck yourself. Okay, that's what you should say immediately to your real estate agent. I don't care who they are, or I don't even care if they're your cousin. Or
if it's a condo, start even sooner.
Yeah, it's just ridiculous. So there's that function of being able to provide a bridge through private lending, which is just kind of a technical necessity in some situations. But on a longer term basis, and remember, folks, we already talked about duration of the mortgage. It's rare that it's going to only be 1 year. That's a very unlikely scenario. So if your mortgage broker is recommending a 1 year mortgage, why would they do that? Now, some people just do that because they know any better. Sebastian's not here to beat up on mortgage brokers, but I can beat up on mortgage brokers a little bit. So that 80% of mortgage brokers don't do fuck all deals a year. Like they don't do many transactions. So they're deep, and they may even work at another job. This may only be part-time to them. So their understanding of how things really work could be kind of limited. And they say to people, oh, I'm sure you can improve everything and just move on in a year. It'll be, I know you're a good person and it'll be fine. But it's not fine. I mean, there's just logistical problems stand in front of it. So it's important to understand, though, that if you're dealing with, now we'll break down the categories a little. There's Sebastian's massive company, experienced, well-organized. And by the way, your company doesn't give a private mortgage to everybody.
No.
You have a set criteria.
Yes.
And we have
rigor.
And you are not interested in ever having to foreclose on that customer. Ever.
No, our business is not to foreclose and own another house.
Period.
It's not the business.
It is the opposite of that. It is, we want you to be with us for 2 or 3 years and then out. Okay?
Yeah, it's really helping Canadians to help them move along and get out of whatever situation they're in to be able to get back to where they need to be.
Yeah. And in the way your corporation works is they also want to treat their investors, the people who provide them with money properly. So because there's every company, even the banks, needed people's deposits. They need people's to buy their bonds. They need.
Correct.
The idea that there is a magic box in the basement of main branch of RBC down on Bay Street, that there's a big, huge box in the basement they pull all the cash out of, is not true. They need deposits. They need other instruments. They need securitization. So that's the same thing is true for every kind of lender. Okay. So there is somebody behind Sequus Capital. There's a group of people behind Sequus Capital who need to get paid their interest too, that they invested in Sequus and they want to get a return. So they want it to be safe, and Sequus wants it to be safe. So there are going to be criteria. There are going to be, hey, do you really make this much money? Because you're going to make these payments, okay? Yeah, I realize you've got bad credit, but let's figure out if you can actually make the payments, okay? Oh, you do have somebody living there now in a room. You got a roomer, okay? All right, maybe we can live with that, okay? You do have this. You do have that. You do have this side job that you can establish that you really have. I'm not trying to express how all your underwriting works. I'm trying to say that you care. You care about that fact.
We have to care because at the end of it, when you look at a file, yes, it's equity lending, but the part of it is that if you can't demonstrate how you can afford to pay the bill, then we know what's going to happen, and that's not something we want to do. So we won't take that deal and put it on the books because it puts us at risk, it puts investors at risk, puts everything. And quite honestly, this is also where, as a broker, when I've had so many calls and they ask me the question like, oh, I want to run this deal by you. I'm like, great. Tell me about it. And they sell me the great story. I'm like, okay, tell me all the bad things about it. but then the inevitable question is, okay, so just so I can do the math really quickly, I do it in my head. I've been doing this long enough. I can do the quick math. I'm like, how do they plan on paying the bill? Because I can't see how they pay this bill.
How do they make the payments?
How do they make the payments? If 100% of their income goes to just paying the mortgage and there's nothing left to pay their car, pay their gas, eat, heat their house, pay for water, garbage, how are they doing this? And then they start explaining. I'm like, okay, yeah, this still doesn't work for us because there is way too much risk. And the reality is like, well, they're going to get an inheritance in 60 days. Right?
Oh, wait, they're going to get an inheritance. Are they going to kill somebody? I mean, like, what's going on here?
Right. But you kind of sit there, you're like, okay, I still can't make this work. For us, not for us. Right. But that's also where investors, when they look at how we operate as an organization and they see, because we have loan loss provisions and you have returns and so on, like we are a proper big corporation.
Billion-dollar company.
Listen, I make the comment as like when I joined the organization and as I got to learn more about it, I said, we are built like a corporation because we are one, but yet we can maneuver like a startup.
Yeah. Yeah.
Because you have to have, unlike a big bank where you're trying to move not one Titanic, but 5 Titanics at the same time, we could be big, but then be extremely nimble. But that allows us to kind of go and be quick and make decisions and look at risk and say, this is somewhere where we need to be. Or, you know what, we were saying yes to this before. Now we're just going to say no.
Yeah.
Because we know what's about to happen.
Markets change. Markets changing.
We're going to be fast. We're going to stop. No, thank you.
So this is the way it does work with large corporations. And there are many. You're not the only one.
No, there's
a bunch of other big, highly reputable, rational. And by the way, when I say, I want to just circle back to one thing. When I say one of the biggest things about these companies, the most important thing about a alternative lender, like a regulated lender, like a home trust, an EQ bank, a community trust, is the chances of you being offered a renewal are extremely high. There's a reasonable chance you'll be offered a renewal from one of these big organizations.
Yes.
But again, if you're not a good payer, you may not.
Correct.
And if market conditions have changed radically, if in your neighborhood the price of houses has fallen 30%, you may not get a renewal. You might, but you might not. Okay.
Yep.
But that's normal. That's normal for the scenario that we're talking about. Now let's go to the absolute opposite, the total opposite of what we've been just talking about. Let's go to the mom and pop lender. Let's go to the individuals just lending out money on their own. So a mortgage broker knows 10 families who are old, those fucking boomers. They got all the fucking money. Fuck those guys. I'm one of them. Okay. They got all the money and they can lend because if they don't have a lot of money, they got big lines of credit on their house. Mm-hmm. And usually they got a lot of money too. Some of them got a lot of money. Mm-hmm. So you come to know about these people and you befriend them and you do some private mortgages for them and they work out. And as a mortgage broker, and all of a sudden now you think, okay, like they don't ask a lot of questions anymore. So I can do any kind of mortgage with these guys. All right. And this is the danger zone. This is what we call sort of mom and pop lending that's in the danger zone. And by the way, none of these people who are in their 60s to start with get any fucking younger, okay? There's no reverse aging with this group, okay? So they tend, as people become older and they've had a good experience, they tend to ask less questions and believe more and more. Not everybody, I'm not saying everybody, but they come to believe more and more and more in the mortgage broker themselves. If they've a couple of good experiences, mm-hmm. got good interest, got paid out on time, okay, this is a good thing. The difficulty is that mortgage broker, when they see people have deep trust, they may be tempted to try to do a little bit weirder deals, like a little bit Instead of keeping all the, if it's $1 million house, I'm willing to lend $500,000 or we're willing to lend $600,000. Maybe we'll lend $800,000 or maybe we'll lend $850 or maybe we'll do a second mortgage and maybe, let's do that. And we give a little bit more interest and take a little bit more risk, but the client really isn't doing a ton of risk analysis. Sorry, the investor. The investor isn't doing the client's happy, the borrower's happy. You'll really give me 85% loan to value in this house? Thank you very much. So that's when things get a little weird. And the other difficulty too is when a mortgage brokerage company who've been merrily going along, and by the way, I'm only referring to people who've do it in the last little while. There have been some mortgage brokerages that have been operating these companies, these MICs for decades too, and quite successfully.
They do a very good job.
Do a very good job, but there's some that have just done it in the last few years. Like there's some mortgage brokerages that have just started doing private lending in the last few years, and I'm not saying they're wrong. I'm not saying they're bad. We do private lending at our company. We are not a MIC, but we do sort of like with that bunch of people who've trusted us for years kind of thing. But there can be a moment in time when, I guess fair to say, Sebastian, some of the lending doesn't make much sense, particularly in this market that we're looking at now.
Yes. Yeah. I get a lot of calls and members of my team we field a lot of calls asking questions, and you hear, and a lot of times the first words out of my mouth is they should just sell.
Sell the house.
Just get out.
Yeah.
Get out, because by the time you're done with the interest rate you're going to pay in a year, the fee, the brokerage fee, the legal fees, the appraisal, add it all up, you're chewing into so much equity. You're better off to sell because, honestly, do we honestly believe the value is going to be higher a year from now?
That's not a good theory. That's a very bad theory. Okay. And also, we understand people want to hold on to their home.
Yes.
We get it. We do get it. We've been doing this forever. Okay.
1,000%.
But there's just the moment where holding onto the home means that eventually a sheriff's going to show up and walk you out. Okay. Because you're much better off to sell. Take that to heart, everybody who's listening and watching. Take that to heart. There are moments when things are going wrong in life and you're just better off selling. It's not going to turn around in 6 months. It's not going to turn around in a year. Which brings us to the next sort of horror show, which is, and we understand bad things happen to good people.
Yeah, I've heard some heart-wrenching stories over the years.
Sure, and there's also like in Ontario today, there's like out of a job. Like if you're one of the 700 people at Bell that was just let go yesterday, I mean, that's a tough thing because, by the way, just think about it for a second. When I read that whole piece of news about the layoffs at Bell, virtually nobody was just started with Bell. They were long-term employees at management levels, okay, and big salaries. And when you're 51 and lose a big salary, you may not be getting it back anytime soon. And if you got a decent-sized mortgage, things can go wrong fast. Okay, so yes, there's bad things happen to good people, and sometimes they should just sell because that 51-year-old who's making $300,000 a year may never make $300,000 a year again. Okay, and hope they do, but they may not. Okay, so what's the danger zone? The danger zone in some cases is the mortgage broker gets paid on transactions. So if you get paid on a transaction, your primary interest tends to be do the transaction. That's how I get paid. So if somebody else is underwriting this, maybe things will work out for this group of investors that I've brought together over the years. I hope things work out, but I think it's maybe more important that I get paid. Okay. And that can lead to bad outcomes. And we've both seen it. And where the really bad outcomes originates from is there's no escape at renewal. Like what if you're doing a 1-year mortgage and that 12 months is up, people like to get paid again. Like the interest rate could go up, sometimes substantially. The fees could repeat. Yes. And you could also just get told, we're not renewing you. So in some ways, that might be good news to that mortgage agent or broker who set you up with that mortgage is not going to continue.
Yeah, because they're
going to they're going to churn it, take another crack at it, see if they could make another fee. And maybe they can't. Maybe the value's dropped. And nobody's going to do a private mortgage. But most importantly, maybe the worst of the worst is the organizations that also plan to strip the equity out of people. So could you touch on that for a minute? Because you know a little bit about it.
Yeah, listen, I think it comes down to, I made the comment earlier, for us, we look at a file, and if we can't see a clear exit strategy,
you don't even do it.
We don't want to do it, because the last thing we want to do is to keep chewing away at equity and then forcing the client to sell. Because at the end of it, if you're having to churn and the next year, to your point, you renew and you have to pay the full fee again on the full balance, you're chewing away at equity again.
And pay another legal fee and pay another, because you switched lenders, so you're paying and paying and paying.
Or even if you're renewing with the same lender. And
they have high fees.
Right, they have a high renewal fee.
Yeah.
Then again, you're going to chew away at it, and as a homeowner, all you've done is you've given it away, because at the end of it, they know the odds of whatever's going to happen is going to happen.
And they may be in their contract, they've built in astronomical fees for defaulting on the mortgage,
potentially,
or for holding. Or maturity. I know you guys don't do that.
No.
Okay. I absolutely know that. But I've seen contracts which are designed to chew the borrower to bits on renewal, because the borrower says, well, I can't pay that huge fee again. Okay, well, the bad news is if you go one day over the renewal date, we're going to charge you another $10,000 just because it's there. It's in the contract. And then we're going to charge for this. We're going to charge for that. And we're going to charge to come out and inspect your house once a day to make sure that it's still in good order. And what the fuck? I mean, this is just insanity, but it's buried in the fine print, and it's designed to chew people up.
And that's why it's so important. Like, and I love this space. Like, I've been doing this, you and I have known each other forever, right?
Long time.
And I love this space. I started off in AAA lending, and then I went alternative and private space. And I love this industry, and it's been great to me, and I've seen all the great things that have happened. But when you look at, in the grand scheme of things, and I've said this, no matter where you are, at whatever level and whatever mortgage you're getting at any institution, whether it's at a bank or whether it's or private, you need to understand it's not just the coming in, what happens on the way out. And that's really when you get to understand what an organization is like and what can you expect on the way out. Now, but there are other times where the reality is, because there's a few of us, like, we don't want to be at that loan to value. So the organization, they're still a great organization, but they're building in the risk because they know that you need the higher loan to value. So there's a cost involved because they're taking a lot more risk to take on that file.
And let's face it, a lot of the bigger companies have built really solid guardrails to say we're not going
1,000%.
We're not going any side of this. Those smaller and also the individual human beings, the mom and pop situations. I don't know some of the things that happen there. We've seen it. You and I have seen it. It's way offside. It's designed to chew up. And again, in most cases, this is a mortgage broker or brokerage that has decided that his income should be derived from chewing people up at the point of renewal.
Yeah,
okay?
But the other time too, and it's we never know when we look at from the outside looking in, is the mindset of the consumer, because they may just be come heck or high water, I am staying in my house and I'm going to figure this out, and they're going to ride it as long as they can to figure it out until the last possible moment. And then they're like, and I'm done. And so there's
that exists. That does exist.
Listen, people are, people who they are, and they're going to go and push, and they're going to want to make sure, like, that's the part where I always kind of play that balancing act. My commentary is, whenever we're asked a question and I'm borderline, I'm like, if you had the money, would you lend your own money? If you had to put $800,000 on the table and let's say you had $1 million in equity in your house, but you can lend this client $800,000 at that rate and that fee, do you really think this is the right thing to do? And if the broker's like, yes, well, great, tell me why, and sell me on it. And then I know they're trying to do the right thing by the consumer.
Sure.
Right. And but we know. And that's why it's so important. We talk about, in the industry, we talk about KYC, right? Know your client. But at the same token, as a consumer, it should be KYB. Know your broker.
Yeah. Know what you're doing. Know the organization you're hooking up with. Okay.
Yeah.
So that brings it all full circle. This is the important thing. And your point is right. It's very right. Some people just say, I'm going to stay in my house. I don't care. I'll find a way. I'll make a solution.
Yeah.
Here's what you and I both know after all these years. We would actually be, as a country and as a mortgage industry, we'd be much better off if everybody just told those people no, and you need to sell the house. And the university heard the same response, and they sold the house, and maybe they were able to get some money first and last, and they could reorganize their lives in a better way, okay? But unfortunately, there tends to always be somebody who's willing to give them a mortgage or give them a worse or higher interest or even more predatory mortgage, and then finally take the house away from them because they couldn't make the payments. It's impossible anymore. So that exists, and to Sebastian's point, know who you're dealing with. Do the research. And I know this is a small group of people. Not everybody needs a private mortgage. Very relatively few, small group in Canada. But if you know somebody who does, or you're talking to somebody, a relative or a friend who's got some issues, and they're looking at, just let them know. They have to study the reputation, the ethical nature, the size, the endurance, the time in business. They need to know who they're borrowing from. It's vital and it's necessary.
Yeah, because we bring a needed level. We bring a not service, but I'm trying to find the right word right now. But we bring to the marketplace something that is really needed because of everything that's happening. If you look at regulatory requirements and so on, we're there, and we help and we save a lot of people to stay in their homes, because I think that's the biggest one. Is like, and I mean, the old CEO of Home Dress, Yusuf Prasada. He's like, our job is to keep Canadians in homes.
Yep.
And it's so very, very true, because all of us, we all look at it. It's like, at the end of it, there is that subset of client. They buy their house and then they're in financial difficulty.
Yep.
But they're fighting. But they're also one of those, they may recognize, like, if I can't hold on to this, I may never
get back.
I may never be able to do this again.
That's right.
So there's that side of it, and you look at this going like, okay, how can I really help you, and what do we really need to do? But as a broker, this is where I think brokers bring an immense amount of value to the consumer.
Yep.
Because the minute, and I said this, I was on stage a couple months ago, and I said this, and I mean this day in, day out. The minute a consumer is in the private space, as a mortgage broker, you should be talking to your client every few months. First and foremost, because you've built a plan to say, hey, this is where you're going to be. And to check up on them and make sure they're where they are, because you can now help them. Because if you realize this is going badly, like, don't wait. Now you need to sell. Like, don't wait. Or, we're going in the right direction. Let's keep doing this. But there's the part, like, brokers bring so much value to the consumer as long as they follow through on what they committed to the consumer.
Follow through and tell the truth.
Yes.
And when it ain't working out, when the plan is not being abided by, hey, there is no renewal. You got to start thinking about selling now. Like, it is necessary. So you're right. There's a tremendous amount of value that can be brought, but at the end of the day, honesty and not just spinning a story to get another transaction done. That's the key. That's what will keep everybody happy and keep the regulator away from you. That's for sure.
Yes, because the regulator, you and I were having this conversation, the regulator is watching. But they're watching on every level. It's not just what you do in the private space. It's also what you do in the alternative space.
Yeah, absolutely.
Because at the end of it, just because you instead of taking him to a big bank and you took him to an alternative, why'd you take him there? They actually could have fit in. Like, so you have to be able to explain the decision and as to the whys. So for me, and I sound like a broken record when I say this, again, first question is like, did you take it to an alternative lender? Did you take it to this person? Did you take it to that person? Because I know the guidelines.
That's such an important point. When the mortgage broker comes to the alternative, to the private lender, to the mortgage investment entity, and says, here's the client, here's what it looks like. And if it looks like, to a seasoned person like yourself, it looks like, wait a second, Home Trust, EQ, Community Trust could have done this effortlessly, and that's a lower rate and a better product. Why aren't you there? Why aren't you going there?
Yeah.
And that's
because we even had we had an example earlier this week, and our underwriting team asked the questions like, why are they not going there? Because I was on the phone and I was talking to the person. I was like, they're like, why are they not going? Because X, Y, these are the reasons why. And then our underwriting team goes, okay, that makes sense. I get why they didn't go to an alternative lender. We'll do the deal.
But you asked.
I asked because
there's a bunch of people who don't ask. Okay?
Because I believe, I hope that I'm good at my job.
Yep.
And I ask the right questions. And I always ask, like, why are you doing this? Like, there's stuff, the minute you hear about credit score and so on, it's like, I know why.
Yep.
Right? Like, some of it is just instantaneous. I know. But when it's borderline, you're like, really? Because I know I could have done this if I was at the other lender. Like, what don't I know? And that's really the value add too, because I look at in the private side, there's the value add because there's so many of us. There's a lot of competition in space, and we're all fairly, our risk appetites are different, but we're all fairly the same to one way.
Some of you are, and
Yes.
some of you aren't. Okay.
Yeah. 100% on that one. Just trying to, me, I'm like vanilla. I just try to be nice.
Yeah.
But the part is that when you're really looking at it is just, have you asked the right question? Because at the end of it, why would you pick me over somebody else that you know as from another lender? Why? Because when you ask me a question, I give you an honest answer and I try to give you guidance. And you may not have thought about that because there's a few brokers I've talked to. It's like, have you got there? It's like, no. I'm like, why? You can do X, Y, Z. It's like, listen, I'll happily do your mortgage for you. Like I can wrap my head around it. It's a good deal. This is what's going to happen. My rate is marginally higher. The fee's still the same. Like really, we're not that far. But in the long term, that is a better product for them.
Because they're going to be there for a while.
They're going to be there for a while.
And that's a better space for a regulated lender.
But then what ends up happening though is I build trust, right? This whole industry is built on trust.
That's right.
And if there is no trust and you know that they're not trustworthy, why would they ever send anything to you?
Yeah, that's all true. Sebastian, thank you.
My pleasure.
You have told the truth about how this works, that there are big differences between some companies, and some private lenders are trying to do the right thing, and some private lenders are trying to do their own thing. And that's what we got to tell the public, is to understand there's a difference. Yeah, thanks again. Appreciate it.
My pleasure. This was a lot of fun.
Thanks. Thank you. And we're out.
If you like the pod, well, don't just sit there. Go to YouTube, Apple, Spotify, and all the other ones and like the pod. And don't forget to subscribe so we can keep being angry at mortgages and swearing about mortgages. Angry Mortgage could use your support.